Global trade de-escalation, how it impacts your investments. The year 2025 marks a pivotal moment in global trade. With a delicate dance between nations shaping the future of commerce, the U.S., a key player, has embarked on a journey to stabilize its trade relationships. And the impact on the stock market is nothing short of fascinating. The U.S. Japan deal, a new era of cooperation. The U.S. Japan trade agreement, a recent development, has set a new tone for global trade. By agreeing to a 15% reciprocal tariff, the U.S. has shown a willingness to prioritize collaboration over conflict. This deal is a game changer, reducing volatility and setting a precedent for future negotiations. Japan's significant investment in U.S. industries like semiconductors and AI is a testament to this new era of cooperation. Equities on the rise, a ripple effect. The impact of this agreement has been felt across equity markets. Companies like Company Name, with their focus on AI infrastructure, have seen a post-deal rebound. Similarly, Company Name's $500 billion investment in U.S. manufacturing aligns perfectly with the administration's reshoring agenda. These moves highlight the potential for companies with strategic capital allocation and diversified supply chains to thrive in this new trade landscape. U.S. EU negotiations, a high-stakes showdown. While the U.S. Japan deal offers a model for cooperation, the U.S. EU negotiations are a different story. With a looming deadline, both sides are engaged in a tense game of brinkmanship. The threat of tariffs looms large, but analysts predict a last-minute deal, recognizing the potential economic fallout of a trade war. The EU's potential investment in U.S. technology and energy sectors could be a game changer, providing a boost to equities in these areas. Strategic sectors. Where to invest? 1. Multi-manufacturing. The U.S. trade agenda has sparked a manufacturing revolution. Companies like Apple, Johnson & Johnson, and TSMC are expanding their U.S. operations, benefiting from subsidies and tariffs. For investors, this sector offers a unique opportunity for growth and stability. Consumer discretionary. With reduced trade uncertainty, consumer spending in discretionary categories is on the rise. Retailers like Best Buy and Lululemon are thriving, and the stable economic environment is a boon for consumer purchasing power. Companies with strong brands and diversified supply chains are well positioned to capitalize on this trend. 3. Import-dependent tech. The tech sector, once battered by tariff volatility, is making a comeback. Companies like NVIDIA and AMD have adapted, reshoring production and securing U.S. subsidies. Thematic ETFs like First Trust Cloud Computing ETF, SKWYY, offer exposure to firms less reliant on global supply chains, making them attractive investments. Actionable investment opportunities. Equity picks. Apple APO, a leader in reshoring, and NVIDIA NVDA, a key beneficiary of the CHIPS Act, are strong choices. Wayfair, Apple, a home furnishings retailer, is also well positioned to mitigate tariff risks. And ETFs. XLY, consumer discretionary, and SMH semiconductors are broad-based plays on trade de-escalation and AI-driven demand. Risks and considerations. While the outlook is positive, investors must be cautious. A failure to reach a U.S. EU deal could disrupt the market, particularly for automotive and industrial sectors. Retaliatory measures from China or the EU are also a concern. Diversification and hedging strategies are essential to navigate these risks. Conclusion. The de-escalation of global trade tensions in 2025 presents a unique opportunity for investors. As U.S. trade policy shifts, companies that embrace reshoring, innovation, and strategic partnerships are likely to thrive. The key is to identify these trends and position yourself accordingly, while keeping an eye on geopolitical risks. The road ahead is challenging, but the potential rewards are significant.